Hey guys, before we get into today's topic, a quick disclaimer. I am a real estate broker in California. I'm not a CPA, a tax attorney, or a financial advisor. This video is for educational purposes only. Tax laws are complicated. Every investor situation is different, and you should always speak with your CPA or tax attorney before making any tax, legal, or investment decisions. Now, with that being said, here's a question for you. How can two investors sell the exact same type of property, make the same profit, close on the same day in the same market, but one pays capital gains tax rates and the other gets hit with ordinary income tax rates? The difference could be $30,000, $50,000, or even six figures. Same kind of deal, completely different tax result. So what makes the difference? One big answer is Section 1231. And if you own investment real estate, this is something you need to understand before you sell. Section 1231 can be incredibly powerful, but it can also be dangerous if you do not know how it works. It can help you or it can cut against you. Let's walk through a simple example. So, say you buy a rental property for $500,000. You hold it for 2 years, which is typical. You rent it out. You improve it. Then you sell it for $750,000. Most investors look at that and say, hey, I made $250,000. But experienced investors ask a better question. How much of that gain actually gets favorable tax treatment? Because if that rental property qualifies as a Section 1231 property, the gain may be taxed as long-term capital gains rates instead of ordinary income rates. And that is where the tax difference can be huge. You could potentially be looking at federal long-term capital gains rate, possibly including the net investment income tax, instead of ordinary income rates that can be much higher than your combined federal and state taxes. That is a big deal. And it is one of the reasons real estate investors need to plan before they sell. So, why does Section 1231 matter? Section 1231 is one of those rare areas of the tax code where investors may get the best of both worlds. Potentially lower tax rates on gains and ordinary deductions on losses. The combination is not something you see very often, but there are catches. And this is where a lot of investors get blindsided. So pay attention. The first catch is the depreciation recapture. We all know about depreciation recapture as investors. If you have owned rental property, you have probably taken depreciation deductions. And if you have done a cost segregation study, you may have taken even more accelerated depreciation deductions. That can be great while you own the property, but when you sell, that depreciation does not just disappear. The IRS may recapture some of it. So, for example, let's say you sell a property and you have $200,000 gain, but over the years you previously took $120,000 of depreciation. That $120,000 may not receive the same favorable treatment as the rest of the gain. Some of it may be taxed at up to 25%. Some of it may even be taxed as ordinary income tax rates, depending on the assets involved. So only what is left after recapture may receive the true Section 1231 or 1231 treatment. That is why the headline profit number is not enough. You need to know what kind of gain you actually have. The second catch is the 5-year look-back rule. Have you heard of this rule? This one catches investors by surprise all the time. If you took Section 1231 losses in prior years, the IRS may require future Section 1231 gains to be taxed as ordinary income until those prior losses are recaptured. So the capital gains treatment you thought you were getting, well, it may not be there. Not because the property changed, not because the sale changed, and it's because your prior tax history changed the result. That is why your full tax picture matters. One deal does not always tell the whole story. The third catch is dealer status. This is especially important for people who flip houses or buy properties with the intent to resell quickly. Your intent matters, and you truly holding the property as a long-term investment is a question you need to ask. Or are you buying and reselling this property as part of your business? Because if the IRS views you as a dealer or a flipper, that property may be treated as inventory. And inventory generally does not receive Section 1231 treatment. That means ordinary income tax rates will apply. Again, same type of property, but different facts, different tax results. And that brings us to the main point. Tax planning after closing is usually too late. By then, the game may already be over before it even started. The planning needs to happen before the sale, before the listing agreement, and before the purchase contract, before a closing statement is finalized, and smart investors model these issues ahead of time. They look at depreciation, recapture, exposure. They look at prior Section 1231 losses if they have them. They review land versus building allocations. They consider 1031 exchange options. They look at K1 income, syndications, partnerships, and other investments that may affect the overall tax picture, because your tax result is not just based on one property. It is based on your full situation. I can't stress that enough. So don't just think about the one property. So if you own investment real estate and you are thinking about selling in the next 12 to 24 months, this is the kind of conversation you should be having right now with your CPA and your tax attorney, especially if you have used cost segregation, bonus depreciation, syndications, a prior 1031 exchange, or partnership investments. These are all things I see in my day-to-day life working with real estate investors. The tax result is not just based on what you sell for. It is based on how the gain is characterized. And Section 1231 can be one of the most valuable tools in real estate planning if done right, but only when you understand the rules before you sell. Before you sell. So here is my recommendation. Before you list the property, talk to your CPA or your tax attorney, have them model the sale under the current existing tax laws, and ask about depreciation recapture, ask about Section 1231, ask whether a 1031 exchange makes sense, and make sure you understand the likely tax result before you are sitting at the closing table. Again, final disclaimer. I am not a CPA, tax attorney, or financial advisor. I am a California real estate broker who works with investors. I wanted this video to be educational and for educational purpose only, and should not be relied on for tax, legal, or investment advice. Always consult your own qualified tax and legal professionals before making decisions about selling, exchanging, or investing in real estate. If you found this video helpful, subscribe to the channel, because I'll be covering more real estate tax strategies, investor mistakes, and planning ideas along the way that can make a major difference before you buy or sell your next property. Anyway, thanks for listening. I hope this was helpful. Give me a like and a share, and leave a comment if you found this helpful, or if you have some true life stories that you want to share with our viewers. All right. In the meantime, I hope this really helped. Thanks everybody for listening and have a great day. See you later.